All right, so we're going to spend a little bit of time now on a case study, and it's talking about the optimal retirement structure. Now, you'll notice in these three scenarios, each client has total assets worth $7.5 million. Now, even if you don't think your assets will get to that level, that's fine. Many of these concepts still remain the same, even if your assets at retirement are 2 million or 3 million or what have you. What we're really looking at is the differences from a cost, income, and tax perspective, both now and in the future, across these three different scenarios. Next, we've got a client with just a $7.5 million home. So this is a classic asset-rich, cash-poor scenario. And you may think, $7.5 million home, that's, an insane value, which it definitely is, but you actually commonly see this for clients where they might be in their sort of 80s or 90s, and they've just had a property in a really blue chip area for decades and decades and decades. So it's a really valuable house now, but they've used all their other retirement savings as they've had a long life. This structure can't work really, and the reason being is there's not enough income. So they've got no investable income, and this client would still get the full age pension. So let's say it's $44,000 as a couple, but the rates on a $7.5 million house are going to be around about $15,000 a year, depending on the council. So that would drop the net amount that person has to live on to $29,000. Now, that's not an amount that anyone could live on. So this strategy doesn't work. Now, it is definitely true that you could sell the house, and that's definitely an option. The problem sometimes can be, as people get older, it becomes more and more difficult to actually leave the house as well. Now, next, with the tax now, there's no tax now, so that's a fine outcome, but we know it just can't work from an income perspective. In the future, the house could be rented out by the beneficiaries. However, it's likely to be sold within the first year, 2 years, as those beneficiaries are likely going to want the lump sum amount of cash. And typically houses worth that much don't have a relatively high percentage income yield. Now, from a tax perspective in the future, it's still going to be fine because primary residence is sold within the first 2 years after being received in inheritance, capital gains tax free. But we just know this scenario just can't work from an income perspective.